Good day, everyone. So we are the Group 2 reporting the Chapter 12, which is about the liabilities. So this chapter aims to state the recognition criteria for liabilities, state the initial and subsequent measurement of financial liabilities, and lastly, is to state the measurement of provision, contingent liabilities, and contingent assets.
Liability is a present obligation arising from past event, the settlement of which is expected to result in an outflow of resources embodying economic benefits or service potential. Present obligation means that as of the reporting date, an obligating event must have already occurred. An obligating event is an event that creates either a legal obligation or a constructive obligation. Legal obligation is an obligation that results from a contract, legislation, or other operation of law. Constructive obligation is an obligation that results from an entity's actions, example past practice, published policies, that create a valid expectation from others that the entity will accept and discharge certain responsibilities. Liability recognition criteria. A liability is recognized only when all of the following are met. First, when the item meets the definition of a liability, example present obligation. Second is when it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. And last is when the obligation has a cost or value, example fair value, that can be measured reliably.
Scope of this chapter. The followings are discussed in this chapter: financial liabilities and prevention, contingent liabilities, and contingent asset. Financial liabilities. A financial liabilities is any liability that is a contractual obligation to deliver cash or another financial asset to another entity. A contractual obligation to exchange financial asset or financial liabilities with another entity under conditions that are potentially unfavorable to another, or a contract that will or may be settled in the entities on equity instrument. Contractual obligation refers to the duty to pay or performs of certain acts created by a contract or an agreement. Like for example, ang isa ka tao is ganahan siya mopalit og motor. So, katong like for example sa Honda, so ang Honda nasa obligation nga tagaan nila, nga gam-an nila og anang magbuhat sila nga katong product or katong entity nga paliton sa tawo is dito nila ibalhin tong pangalan. So therefore kato po mo palit na po sila obligation nga bayaran pod kato ilang gipalit. Example of financial liabilities: accounts payable, notes payable, interest payable, loans payable, bonds payable, and bail bonds payable. Initial recognition. A financial liability is recognized when an entity becomes a party to the contractual provision of the instrument. Contractual provision of the instrument is a stipulation within a contract, legal documents, or law. Initial measurement. Financial liabilities are initially measured at fair value minus construction costs, except for financial liabilities at fair value through surplus or deficit. Example, designated financial liabilities and derivative liabilities where those transaction costs are expense. Transaction costs are incremental costs that are directly attributed to the acquisition, issues, or disposal of financial instrument. Subsequent measurement. Financial liabilities that are subsequently measured at amortized cost, except for financial liabilities at fair value through surplus or deficit, which are subsequently measured at fair value. Subsequent measurement depend on the category of financial instrument. So, ang subsequent measurement is magdepende siya kung saan category dito sa financial instrument nga gigamit.
So when does recognition of financial liability happens? It happens when it is already extinguished, being discharged, waived, cancelled, or it expires. What is provision? It is a liability or uncertain timing or amount. A provision is recognized if all the recognition criteria for a liability are met. Just for example, present obligation, probable outflow, and reliable measurement. If it happens that one or more of the criteria are not met, the items is a contingent liability, not a provision, and therefore not recognized as liability. So what is contingent liability? Contingent liability is a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Or it is a present obligation that arises from past events, but it is not recognized because it is not probable that an outflow or resources embodying economic benefits or service potential will be required to settle the obligation, or the other one is the amount of the obligation cannot be measured with sufficient reliability. Contingent liability is one that met some but not all the liability recognition criteria. A contingent liability is not recognized but disclosed only if its occurrence or settlement is reasonably possible, otherwise it is ignored. How about the contingent asset? It is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. So it is not recognized but disclosed only if its occurrence or realization is probable, otherwise it is ignored.
Measurement. A provision is measured at the entity's best estimate of the amount needed to settle the liability at the reporting date. Risks and uncertainties shall be taken into account in reaching this best estimate. If the effect of time, value of money is material, the provision is measured at the present value of the settlement amount discounted at the pre-tax rate. Gains from the expected disposals of assets shall not be taken into account in measuring a provision. Provisions shall be reviewed at each reporting date and adjusted to reflect the current best estimate. If it is no longer probable that an outflow of resources embodying economic benefits or service potential will be required to settle the obligation, the provision shall be reversed. A provision shall be used only for expenditures for which the provision was originally recognized. Reimbursement. If another party is expected to reimburse the settlement amount of a provision, a reimbursement asset is recognized and presented in the statement of financial position separately from the provision. However, in the statement of financial performance, the expense related to the provision may be presented in the net of the reimbursement. The amount recognized for the reimbursement shall not exceed the amount of provision.
Application of the recognition and measurement rules. These are future operating net deficits, onerous contracts, and restructuring. In future operating net deficits, there will be no provision should be recognized for expected net deficits from operating activities as such assets used in these activities are impaired. In an onerous contract, a contract is deemed onerous or burdensome if unavoidable cost of settling the obligations under the contract exceeds the economic benefit expected to be received from it. Obligations from these contracts are measured as provision. Restructuring is a program that is planned and controlled by management and materiality change either from the scope of the entity's activities or the manner in which those activities are carried out. Restructuring obligation includes only the direct costs resulting from restructuring and does not include costs associated with the ongoing activities of the entity, like marketing, investing, relocating, retraining in new systems and distributions network. A legal obligation to to restructure exists if the entity has entered into a binding agreement to sell or transfer an operation at the reporting date. Meanwhile, a constructive obligation to restructure exists if the detailed plan for the restriction and the plan is announced to those affected by it are present at the reporting date.